Paul, how are you, man?
I'm doing well. Thanks, Ryan. Thanks for having me today.
Yeah, I'm super pumped, man. I was thinking about what I actually was thinking about where I was when I interviewed you last, because it was like 3-4 years ago, I think, right before our world got flipped on its head. And I was super excited as I was thinking about this mini series. I'm like, a lot of, we covered family offices in the past, and when you and I were chatting, like, how you were different compared to different options. And I'm like, this is so timely because I think there's been a lot of family office activity just in general in the marketplace. And you were so pleasant to just talk to you because you just laid it all out there, man. So we're gonna go back and we're gonna do some of that again, and I'm very excited. But for the people who have not heard that episode, why don't you give a little bit of your background, how you got to where you're at, and then we'll talk about then the family office that you're in and kind of your structure, and talk about how it's different than some of the other things that are out there.
Sure. My background is in commercial banking. So I started my career in Chicago in commercial banking, and kind of had a progressive banking career and moving up the ranks, and life was good. And things got turned upside down a little bit in the 2008, 2009 timeframe. And I was part of many bank, M&A transactions. And throughout the years, kind of enjoyed those different experiences, but always working with middle market businesses and business owners and their unique situations and different, economic cycles. And then personally, my wife being from St. Paul, there was a time that it made sense to move to the Twin Cities. So we're here now. I did a little more banking here locally, but just kind of by serendipity and happenstance was connected to this really interesting group, Encore One, a number of years ago, and joined about 5 years ago, really in an effort to kind of reinvigorate the marketing effort of what we were doing. Encore One itself is a 25-year-old organization that is really a family-owned investment holding company. Maybe one thing that's changed since we last talked, I might have referred to it as a family office, and I'm refining, I think, and I think it's helpful for the audience as well to maybe understand the distinction. So now I call it a family-owned investment holding group, 25 years old, which makes it, I think, very unique. There is the concept of the family office, I think, is kind of in the zeitgeist more frequently now these days than maybe it had been in the past. But I'd like to thank our founder and patriarch, Jerry Roundhorse. He had the idea a long time ago in the late 90s. And his idea was really to keep, and his wish and his desire to create a legacy was to keep the ownership of his original business, which is Opus, now known as Opus Group. So it's a series of kind of family-owned construction companies. He wanted to keep Opus in the family for generations to come, and kind of a unique request. The way he did that is the shares of the construction company were kind of contributed to two family trusts, two generation skipping trusts, for the benefit of future generations of Roundhorse family members. So the family are really beneficiaries of a family trust, but recognizing long-term real estate and construction and real estate development were cyclical and risky. He thought it made a lot of sense to diversify the family wealth away from just construction. He set up Encore One as a sister company. And our goal and mandate was to make direct investments in middle market operating companies. So the types of companies
was that sister company separate out of those trusts? So and honestly, this is just super fascinating, I think, for the listeners too, because I think, as the, wealthier families have kind of gotten a little bit more publicity over the last handful of years, like, what's the purpose? And so it was very helpful of like understanding the businesses and stuff like it, but kind of set up like I don't know if there's like a landscape, because they got their hands in a lot of different things. I don't know if it's all within these trusts or if it's the different entities in general that they just that are controlled, or how does that work?
Yeah, I guess largely within the trust. So they're sister companies, they're affiliates, they're not subsidiaries or parents. They don't own each other. Only the trust owns.
Okay.
The different businesses. The different businesses are very intentionally run separately, not to mention they're all in separate, industries with their own needs and challenges and different, unique functional business areas, that sort of thing. So Encore One was really just set up to diversify the family wealth away from just construction, real estate development, but also it created this really interesting vehicle where, Encore One could buy companies from founders where the founder had a strong desire, like Jerry, to create a legacy, but perhaps didn't have, children or family members in the business or interested in taking it over, yet they had a strong desire to kind of see the business, grow and last long into the future. So we're in a very unique, legal and corporate structure that allows for that really long-term growth and ownership. And, the family trust is the source of capital for our investments. So we don't have to take outside capital necessarily from third parties. We don't have outside investors that we raise capital from. So there's nobody to necessarily, return an investment to or
tell you what to do.
or right, exactly. So we have a pretty clear agenda and purpose once we buy a business, and that's kind of to support their long-term growth. And what, then I get asked the question, like, what do you get out of it? Like, how do you get your return? And it's really about capital appreciation and diversification. So kind of safety and security of that family estate. And, of course, there's excess cash flow in these businesses potentially if they're, strong companies and run really well. But, generally that's just kind of reserved for taxes. And, from a return standpoint, if there's a better investment opportunity that helps grow a business, that's, more useful to kind of the overall estate rather than, taking out large distributions that are sort of unnecessary and kind of mortgage the future for some sort of, short-term return today. So it's a really unique legal structure.
That's okay. Sorry to interrupt, but I wanted to pull that thread of like how you're talking about distributions, how the capital appreciates inside of that. But before we get to that, I want to kind of back up a sec. And because like when I'm always describing family offices or family holding companies, with given your how the structure, I want to make sure it's accurate. But like, there's always a choice of a wealthy family to either go down your route or go give money to private equity, right? And so I don't know if you've got any insights on like why they decided to go the route that you are. Maybe you can kind of describe those two, because I end up doing that a lot, Paul, where I'm like, okay, like, so when they say family offices in kind of in our private equity section of our training, but it's like, well, there's a lot of different flavors of that, of how, a wealthy family can deploy their capital. So does the question make sense on how to kind of compare the two?
Yeah, I think so. I mean, I can speak to our group, and of course, every group is different, unique structures and setup and different sort of, growth and asset protection strategies. So I guess the reason I call Encore One, not myself, but Encore One, a family holding company, is because we're really one asset class within a diversified portfolio within a family office. So we do have, colleagues here who are in a different group, and they are doing what you're describing. They're more, they're investing in managers, so fund managers of private equity funds. We're doing our thing, which is what I would call direct investing. And then there's, another group that is doing, real estate investing in the form of a private equity fund themselves, but that's a different model. So, and
just to be clear, like
that's actually our fourth group, rather, that's kind of a captive tax consulting group. So,
and don't you have a bank too within the organization, like a commercial bank?
Guess so. That would be affiliated in the Encore One group. So a bank just being another operating company. So the bank doesn't fund any of our family office activities. It's really run independently. It's got its own, customers and CEO and CFO, and that's, again, run sort of separately. So it's really the public market investing, the direct investing of Encore One, and then there's a real estate investment group. So in some family offices, like all those, asset classes and the allocation of capital to those different asset classes might be run by one individual. But in our case, there's sort of three different groups with three different sets of, professional managers doing something different. So all different skill sets, but
super helpful.
And then it's really a matter of kind of resources and asset allocation. So if I guess if I were a wealthy person myself, I would earmark some for the public markets or for other private equity funds, as you're saying. That's great exposure. Those are professional managers with, great, return metrics. I'm sure that they're able to generate. But I'm entrepreneurial, so I might have another sliver of my, asset allocation directed towards what you're describing, either, which I don't want to call private equity, I would call direct investing. And maybe they're direct investing in, mature companies because that's the line of business they came out of. Maybe they're really passionate about, early stage venture investing and helping other entrepreneurs get off the ground. That's really risky. I wouldn't allocate a lot to that but maybe it's an area I really know really well and am passionate about. And maybe there's a tax and a benefit to also investing in, real estate or utilities or, other industries that are on different cycles than the rest of my portfolio, for example. So,
Paul, that's awesome.
It doesn't
all
have to be one thing or another.
It's awesome because that in different words, that's kind of what I've always described to people. I'm like, one person has got like the pie chart of the colorful different asset classes of different expectations of the returns, and you just like they're just divvying up big slices because the pie is so big, right? And so you're in that direct investing, so that's so helpful, man, with the context. And that kind of going into continuing pulling that thread is when you were saying that because of with the rest of the background of the family that has cash flow, dividends, appreciation in different asset classes, the expectation of your piece of the pie, when you were talking about like how, what's the purpose, and like how does that work? And you were saying like, so how did you word it where like you're not taking the dividends out necessarily because of the capital appreciation, because that's all giving insight to the why they're doing that. So we want to kind of continue or re-explain that, like that philosophy that you guys have there?
Yeah, I guess, you can think about it different ways, like return on equity versus an IRR would be maybe a traditional private equity, sort of benchmark. But I guess you can model anything, that doesn't have to be like a realized IRR, but that could be like an expectation or a parameter upon which to make a investment decision. Is this a good investment or not? If it were if it's capitalized like a traditional leverage buyout or what a private equity fund would do traditionally, is this a good investment opportunity at this, purchase price with this capital structure, with this growth profile and exit expectations? But it's really just a tool in order to make an investment decision, because I guess overall the trust does have opportunity cost. If it's not a good investment, they might as well just stick it in the, the public market investing group, for example. So, but the reality is, you've made a good investment decision. I keep saying but we might decide not to actually, realize that investment and just let it, grow and appreciate. And, hopefully that's possible because of, there's a great management team and interesting industry dynamics, and there's, organic growth and consolidation opportunities. And as long as, a business is growing and profitable, like just let it keep going. We talked about a little bit before we actually got on camera here. If you think about it in a different way, we've owned a business and we've got one, for example, in mind, I'll say, but it's grown really well. We've owned it for 20 years and it's, created a lot of value on paper, and there could be a fantastic exit opportunity. And, most of us mere mortals will say, well, just take the money out and, enjoy
mere mortals.
It, I guess,
yeah, you're mere mortals.
But that's just not our mandate, that we're professional managers. There's a trust. The trust has like certain goals and expectations. And again, it's designed to last forever. And so that's a much more unique than, you or I who, only have a couple more years left on the planet to maybe enjoy the results of that growth and value. So it's just a different calculus. And if you were to have that, big exit and, it's great, but, we're really working for the benefit of future generations.
Then you have to go figure out what to put
family members. So then you just have to take that money that was generating this fantastic return anyway, return on equity, and go invest it somewhere else and chase a bigger, potentially more risky deal than the one you already have and is growing nicely. So, another way to think about it is if you're going to own something for 100 years, like what's the present value of all that cash flow? Just the multiple that you could get paid today probably isn't big enough to, make that equation work, to make the make the exit more valuable than owning it for, decades longer in the future. So
it's awesome, Paul.
It's a unique position to be in. I'm not a family member. I'm an employee and manager, I guess, but that's the mindset that we have, I guess, when we're making, creating relationships, hopefully building trust with business owners, and, making investment decisions that are, good for the business, the employees, the remaining management team, as well as our group.
Dude, awesome context, man. Because what I've been trying to do with these episodes then is give all of the context behind the scenes. So when, business owners are sitting there having conversations, they know essentially how to follow the money. Where are the decisions getting made from? You don't have a 3 to 5 year term that you have to, I don't know how Brent B. Shore worded it, but rip, flip, and whatever the heck it was, and again, it's not to knock the traditional private equity market. It's just a different mandate, like you said. But what that does is
it's big, it's profitable, and it exists for a reason. There's terrific outcomes, potentially for business owners, and then those private equity funds, the managers, as well as the investors. It's a successful and growing market, for a reason. That model works. Maybe not 100% of the time, but that's why they also get fantastic returns, because the ones that do work really well.
Mm-hmm. But absolutely. But when thinking about from the seller's perspective, what's important to them, right? And how to determine based on what's important to them, their legacy, their role, the employees, the community, and then the deal structure and the price. We're trying to make that in our training, it's principles 1 and 2 is a lens to say, okay, if Paul has got an offer in front of me, what is it? What's the purpose of the deal? What's the structure going to look like? What are you going to do with all that stuff? And that's some of the stuff I want to kind of unpack with you, just from your perspective, right? Just to help them understand that you're one family office with one direct investing. There could be a lot more with different mandates, but at least they understand. And just from a place to start too is your goal is not to just sell it in 4 years, because then again, you'd have to figure out what to do with the rest of the money and go back and buy another company, to your point, which then leads me to think of how you're mandating, and I don't know the deal structure, we can get into that, but reinvestment instead of having it so levered that they can't reinvest. Right. And so that's where I'm trying to, how we can go. So when you think about, let's maybe start with, what is when it's a great fit for you guys? So think about maybe one of your current portfolio companies or someone that you've talked to, and he's this is a perfect fit from what they want and the deal structure. What would be kind of the ideal person where you're okay, there's a lot here?
Yeah, I think, first it would, let's say for a platform company. So it would be in a new industry, maybe that we're not already in. So it would be a platform in that respect. And then it's got a certain size, that's makes sense for us and our pocketbook, in terms of the size of the equity check that we're looking to write in order to be efficient. And these deals take months. So, we can really only do 1 or 2 really good deals a year or two, because we do have a kind of small, sort of closely managed group as well. We're not set up like private equity for a lot of velocity and to do a lot of deals. We're looking for 1 or 2 really, really good ones. So in terms of size and as a reflection of our pocketbook, it could be, a $4 to $10 million EBITDA company in the traditional sort of industrial business services, manufacturing, distribution, that kind of stuff. We don't have experience with and stay away from a lot of, heavy tech, not tech enabled, but just technology companies, retail, consumer products, really dynamic kind of cyclical industries. Anyway, but that said, you kind of have a picture of the sort of mature 40-year-old good,
plastic injection molding, steel fabrication. Right?
Yeah. Some of those as examples for sure. So, and then beyond that, number 2 is, this is not an original thought, but a strong management team. So, usually are a good audience or a receptive audience, I guess, to our message and approach is an aging founder who's nearing retirement, who's in their 60s or 70s or even older sometimes, who has got a great business, has trained up and coached up, and has a great, bench and strong management team that's really doing the day-to-day. And then that owner, usually 100% owner, but doesn't have to be, just kind of has a really strong affinity for the team and, and keeping it intact and kind of providing them long-term sort of employment prospects, but even, professional growth opportunities as well, that they're just not able to provide. And maybe they're at the end of their sort of risk tolerance rope. They just don't want to take new risks. They don't want to make another acquisition, start a new product line, enter a new market. Yet the team's like chomping at the bit with all these things they could be doing. So anyway, that's kind of a good signal that it's time to move on. But that owner seller has maybe a really strong patriarchal attitude towards the business and wants to see it taken care of, whatever that means. That said, they want a fair, full value for their business. And I get that. At the end of the day, I think our approach is nice. Maybe it's worth a little bit of money, but it's not worth, multiple turns of EBITDA when you start talking about $5 million in EBITDA. Is it worth $5 million less? Maybe not. Maybe I'll take Encore One's offer for, $2 million less. Maybe it's 28 versus 30, that kind of thing. But there has to be a high level of trust, a lot of comfort with our group. And then again, the future opportunities, the money's got to be right. And then the future opportunities, I think, for those employees. So it's not for everybody. If it was a fast growing software company that was only a couple of years old, had a lot of outside investors, that business needs to go to the highest bidder, it needs to go to auction, that sort of thing for sure. That makes a lot of sense. But if it's your business, so to speak, the seller owner, they can kind of make those sort of non-financial decisions about where, their comfort lies with the type of, buyer that they would potentially be wanting to work with. So, it's size management, and then I guess disposition of the owner. Are they receptive to our approach? Is it something they care about? It's not for everybody. It can seem kind of silly and Pollyannish for some, and talk about legacy might really not mean anything for some, but for others, and some of our outstate communities, that can be really important. And that's my job, I guess, to find those. To find that audience, and usually it's through the trusted referral network.
Well, I think it's I appreciate you being humble about your guys' approach, but I think that there's from just my own perspective, Paul, like the hundreds of people have been through our training. The general majority are founder partnership led, privately held businesses, and they do care for the most part. I would say it's an abnormality and an outlier for someone that's like, I don't give a shit about any of my people or my vendors or any of this stuff. I want to sell this at max purchase price and gut the thing. Generally they're kind of forced into a situation like that. So I think what's an interesting note about what you said though, and this kind of maybe leads into the deal structures that, Sonny Vanderbeck was on the show. He's got a long-term holding kind of conscious capitalism private equity firm too. And he's like, you can legitimately maximize purchase price by someone levering this thing up with a bunch of debt. But there are huge implications, even if you're not Mr. Woo-woo culture stuff. There are implications of having zero wiggle room between taxes and debt payment to fund your growth, right? There's a law of diminishing returns, I think, at some point, if people understand that. So the $28 to $30 million, choice, my question would be, I would challenge the listeners, is that even a choice, right? Is that if depending on that max purchase price offer, what are the implications of the deal structure and trying to run a business like that after that, if it's even possible?
Yeah, no, that's a good point. So, as I said, we're modeling, I guess, our potential investments and making decisions based on I'll just call it a traditional private equity model or LBO model. But there are ways to kind of juice those returns potentially. So you can offer that entrepreneur, more money. So the $30 million, for their business. But because of the short time frame you have to run it and flip it, as you say, or sell it or exit the investment, there you can, an investor could over lever it, potentially, and sometimes I guess they would never intentionally do it to the detriment of the business. And there's pretty thoughtful ways, I guess, to kind of structure that debt, but. We would go to traditional commercial banking sources. We're not going to leverage, credit funds or anything like that. And those funds exist because they're looking for an exit too. They're not necessarily looking to see the 30th year of the amortization, but, that debt, I guess, comes at a cost, as well, which puts more pressure on, the business to grow and grow quickly.
How does
In
that
a lot of
impact?
cases, there's rollover equity involved in that. So, I mean, you could make the argument, well, you've sold most of your business, but now you're the minority owner of a highly levered business that has this, really ambitious growth expectations over the next couple of years. And I don't want to sound too biased from the position that I'm sitting in. I mean, obviously the parties wouldn't get involved in that deal and that structure unless, there was a real strategic plan to grow the business. But it does put, new pressure on the company and the managers, I guess, generally to sort of perform and reach those goals and metrics in order to realize, the second bite of the apple and those kind of exciting things. In our structure, I guess it would be maybe more conservatively levered, which isn't bad because we're putting in more equity, which we can afford to do because we're owning it longer. So there isn't the same pressure. We want a good return on our equity as well. So there is growth and profitability.
You guys usually put like a rule of thumb, is it like a couple turns of EBITDA of debt or something like that? That's super reasonable.
Yeah, I think, for some companies, if it's slower growth and more capital intensive, it could be, 1.5 to 2 times of leverage. If it's, strong and growing really well and there's good free cash flow, it could be, 2.5 to 3 turns of, senior debt financing. We'd use our own sources for, what we call mezzanine or subordinated debt, but it still comes from the trust in most cases. And then the balance would be funded with equity. So, depending on the purchase price and the situation, we generally, appear to be, I think, an attractive debtor, I guess, to, banks, in that, we're putting in more capital than what they're contributing necessarily. And hopefully, again, that's a comfortable place for the management team to then operate and hopefully grow the business that, we can afford to kind of continually reinvest and grow the company. So that's just our approach.
I know, but which is why you're on the show, because I wanted to hear your approach, because the whole point is to compare it around norms or conversations. People are getting their doors knocked on all the time, and we both know that there's like $1.5-2 trillion of committed capital already that's got to be spent. So like these people are getting their phones ringing a lot. And so going back to kind of like, again, so just using your example and your guys' structure as something as relativity, like, okay, how does that compare to other things? And going back to kind of like, that was very helpful in the deal structure, but let's say it was 2 offers, like the $28 million, let's say it was 35, but the $7 million is going to come in that rolled equity or a promissory note, and it's fully levered, and you've got 3 years compared to getting it all up front, or I don't know how you guys do it. That's what I'm trying to get at, is like, what are the anticipated like new mandates after the closing, right? Because like that could dramatically depend or dramatically change what someone's desire is to pick you versus someone else. And this is, again, the point of the show, is that all offers are not equal, right? You have 2 offers, it's enterprise value, but when and how you get your money is completely different. And so like people need to be aware of that.
Sure. Yeah, no, I mean, that $7 million could be at risk. It depends who the shareholders were. Is it a 75-year-old with health issues who's got to roll some equity and isn't really even involved, doesn't have his hand on the wheel or her wheel driving the business? Or is it a couple of remaining shareholders who, are maybe longtime employees, they're in their 50s. It's a really exciting opportunity for them, actually. That could make a lot of sense. And that might even be something in that situation that we would, consider, as well as other, incentive comp programs that are hopefully exciting and align our interests with management and their goals and their wealth creation, opportunities and goals as well. So it all depends. But yeah, if you're, aging, you're not involved in the company anyway, to have to roll and you're the 100% seller, owner seller, that might be disingenuous, I think. If you're a 45-year-old seller and you want to roll some equity and you still have the passion to like grow and lead the business under this new ownership, you just need a little bit of more growth equity and support to grow the business. Like that could be really exciting. And I totally get that. So you're going to have a new boss and somebody to answer to, and, they're going to be in your back pocket every Friday afternoon. But, it's a little bit of what you signed up for, and that could be an exciting opportunity. And, nothing's without, cost and risk, for sure. Like, they say in any kind of investment perspective, we may not ultimately be successful in achieving our goals, but, it
Hence the
could be
definition of risk
way to
versus
try.
return, right?
Yeah. So, those are, meaningful structures for sure. And we do some of that, I guess, where, the situation is sort of appropriate. There's other financing structures kind of depend. Maybe it's a really lumpy cyclical business and it requires a more friendly debt financing package and some seller financing, that might be warranted in some cases. And that can be really attractive if maybe the seller is like sticking on in the management role, again, has their hand on the wheel and they're able to earn some additional interest that they couldn't otherwise, get in the open market, that sort of thing. So those could be good opportunities. So every situation is unique. I guess our approach, and it's a reflection of our long-term ownership, is that we could be flexible. We recognize there's multiple stakeholders, if not just shareholders, that might have an interest in this transaction or it being successful or in the newly formed entity. And they're really important to the deal or the legacy of the company or the culture or the continuity. We can find something for them too. And I think we can afford to be, thoughtful, strategic, and because we're, long-term. And I should say certainly there's other long-term investors out there that don't have a traditional fund to answer to. So it's not just Encore One. It could be, family offices generally, other independent sponsor type search funds, just groups with longer term horizons for sure.
So then what is your guys' approach towards that management team as far as like, it's maybe kind of a two-part approach or a two-part question, Paul, and however, make sure that I want to make sure that the question makes sense is like how you guys, like when you're assessing the management team and the strategic plan, it's probably both of like, okay, where's the company going? What's the potential and who's, driving that ship? How do you guys assess both the management team and the strategic plan? And then how do you guys interact with the strategic plan and the management team and the operations after closing?
Yeah. So I guess after closing, we certainly take an active position on a board. So, it's myself, my colleague here, Craig, who's 20-year president and CEO of Encore One. He's got more experience than I do, but certainly all the kind of tribal knowledge, how we do things and formal policies, that sort of thing, and real bona fide M&A experience as well, having been an investment banker in a past life. So we're on the board, we're, supportive board members, I guess not like an operational board member. I made a note to mention, we're investing in different industries intentionally. So we can't be experts in all these, areas of business, but, have got kind of broad experience to bring to the table and to provide a sounding board to the remaining management team and to support their vision for growth. Annually they're presenting their budget, their strategy for the year. We're asking questions. We're thinking about, mitigating risk both for the business and I guess the family ownership group as well, but not really, mandating, I guess, the direction of the business. When they supporting, inorganic growth opportunities, both looking for and executing and negotiating on, M&A growth opportunities. We think we're a great partner in that negotiation discussion with the prospective add-on, or bolt-on or follow-on.
I can only imagine having a big chunk of money in the resources. If I was one of the platform companies wanting to acquire some, I'd be like, well, here's my friend Paul, who's got a war chest.
Right. So we represent the friendly, deep-pocketed investor. The CEO we're partnered with, so to speak, they can speak to, for this friendly competitor they might be, inquiring to buy, can say, no, it's been a great experience. Encore One or others are, terrific partners and investors. They've done what they said they were going to do, that sort of thing. So I think both for the platform management company as well as at like prospective add-on, having Encore One, as you said, is kind of the deep-pocketed investor and this really friendly long-term approach, is a much softer landing for a lot of not only the business owner seller, but like the remaining management team and the employees as well, just to have sort of, long-term visibility into what their job prospects are. And that's often the most important thing to many people But not only that, but that there's growth opportunity, and this group's going to support us, on the one hand, but on the other hand, stay out of the way, so to speak, not setting up shop, opening up an office, putting in our own, operating partner expert to kind of monitor, I guess, the business and the month-to-month progress towards, reaching some sort of goal in support of a, future exit.
You guys are.
There's two sides of that. It's not, we don't run and open greenfield locations for you to grow, but to the extent you identify those opportunities, and we help with that, certainly from the capital formation standpoint, as well as kind of thinking through the risks and challenges of those opportunities. But
it's more. Is it safe to say it's more about capital deployment and capital preservation and capital growth versus like, hey, Paul, I'm one of your platform companies and we're like looking at this new ERP system. Like, you're not getting involved in software selection or, executive recruiting or service providers, or are you? I mean, does that make sense? Is it more on the capital side?
I suppose if they ask for it, if they want to, do you know any really knowledgeable consultants with, SAP or something like that, or, really good executive recruiters with experience in this space, we could, support that. Otherwise, if that's a project they were working on, maybe they would share that with the board, and we would ask them, who are you interviewing, and make sure they weren't just interviewing one party, that kind of thing. But pretty basic blocking and tackling. And if they wanted to go spend a couple $100,000 on some new, software upgrade, I don't know that we're gonna kind of get into a deep discussion or an analysis. And by the way, we're not beholden to any vendor. We don't say, no, sorry, we have a corporate buying deal over here, for better or worse, that you've got to use this provider because, we get some sort of, or we enjoy some sort of discount at the top of the house. Again, these businesses are in different industries. They have different needs, different vendors, service providers, accountants, attorneys. So they've got their own, group of key professionals. And we like that, if we can kind of spread the network and, choose the best in class for the right situation as well. So, and there are groups, that have a shared services model. It's really interesting. We just haven't, gone that route necessarily because we think, diverse businesses in different industries, they just all have unique needs.
I think it's a really important distinction, Paul. Like you said, for better or for worse, this is all about like, what does everybody want? But like,
right.
I think about like when I look at the deals that I've been on the part of or in the peripheral of or whatever it is, it's like you get the capital and the deal structure and the price and terms done. Then it's all of the adults pissing on each other about what systems we're going to use and who had what sunk costs into what project. You know what I mean? So it's really, then like people being validated that they're professionally growing in whatever position, and whether it's COO or CFO, and they chose and went through a whole, systems implementation. And then I've watched people then go, I did all that, and now the new owner is sandbagging that for whatever system that they like, right? I think it's important because, for someone that has got a lot of pride in what they've built or thinks that it's the right thing, I mean, you could really upset the apple cart, even though it's got a good management team, for a bunch of people that don't feel respected for making those choices afterwards.
That's a great point. And, when I do get asked that question about either what are you going to do to help me, or do you have any shared services? On the one hand, I think, ooh, that's a good point. Wouldn't that be nice if we could say, hey, we'll take over your insurance programs and your accounting and finance. You don't have to worry about any of that stuff anymore. Your HR. And again, each of those functional areas of a company, they all have unique, issues and problems. And then I think, on the other hand, how good of a deal is that if you go in there and say, employees, hi, we're the new business owner. We're great. We're supportive. We're long-term. By the way, CFO that's been here for 20 years, that's awesome. That's helped grow this business strategically. You have a new boss. Like, that's not really a great endorsement of this, friendly long-term approach as well. So that can be, disintermediating as well. And so, we're really thinking about, in terms of, creating value is not really, cutting costs or consolidating it at a corporate level. It's about hopefully, creating an exciting growth opportunity for these people. That's where our value creation is going to come from over time, not through cost cutting in the next 3 years.
Cost cutting or just micromanagement of I think because again, you and I don't know if it was we had hit record yet, but they're two huge different options, neither right or wrong. It all depends. We're if someone's looking for to level up their professional management systems and all this stuff, and they're looking for help implementing a new ERP system or accounting system or lean manufacturing, whatever it is, and that's what they're looking for. Some people also aren't. They're stay out of my sandbox because we've got this and we've been running this for 30 years. I mean, it just completely depends based on what people are looking for. So I think it's just helpful knowing that we're, just again, these are questions people should be asking. I don't think it's right or wrong. It's just, it depends on what people's expectations are and how close those are to reality. And then following some of these conversations is let's say they've got, they like kind of the arm's length and the support, but they've got kind of their own management team, their own strategic plan. How do you guys get into conversations about what's possible with additional capital? Because I think about organic, they're sitting at themselves, they're growing from cash flow generating by operating activities, or they've got their own, traditional bank financing. But then, hey, we could do this outside of acquisitions. Let's say it's rolling out another project or increasing their ability to scale because they can lean into working capital that's provided by you guys. So how do you guys support more aggressive organic growth plans for someone that might have that desire?
Yeah, I guess it depends what the investment is in order to get there. Is it new machinery and equipment? And again, maybe under the old ownership, maybe they were really debt adverse, or just didn't want to take the 2-year, time and investment, not only for the equipment, but then you have to update your marketing materials and educate distributors and dealers and change the comp plan or incentive plan for, sales folks. Yeah. And that just sounds painful, even though on paper, this $2 million investment in equipment could generate, X and, $6 million in new sales over the next couple of years. That, sounds amazing, but there is a lot of, work and heartache, I guess, that goes into that, strategic plan. So I think, again, because, one, we're not, traditional private equity, but two, we're not aging per se, that, we do have this long-term ownership perspective. So I think those, kind of plans, I guess, we're there, maybe we're just there insofar as we're not going to say no, that we can be supportive. I don't know that we're really digging into an analysis unless there's, is this a, project investment going to generate a certain level of return? I think we want it to be accretive to the business and, the enterprise or the value creation that's there sort of on paper. But if, I think largely we're kind of relying on management and their, industry knowledge that, this investment is the way to go. And I guess that's an easy example as far as equipment. You talked about working capital. I mean, we do have relationships, strong ones, I think, with banking resources, and we can help, especially in a case where maybe there's a really strong controller, but not a super strong strategic, CFO. We can help sort of model and make the case that, this adjustment to our working capital facility will make a lot of sense. And for this reason, it's going to drive, additional growth, profitability, and also, help pay back the bank or, improve our credit profile, those kind of things. I think we've got the expertise and experience as well as the credibility to help make those cases where necessary. So
do you guys leave the cash that's generated in each entity, or do you swoop in and scoop out the excess cash and put it at the top or the higher level of the hierarchy? Or,
I mean, largely it's left for, well, not left, but largely it's, these are pass-through entities for tax purposes. So it's distributed for taxes ultimately.
Okay.
But in terms of excess, cash that's kind of pulled out of the business, no, because usually if a company's growing and profitable and generating all that excess cash, maybe there's other opportunities that are more profitable. As you said, there's an opportunity cost of making a bunch of excess distributions and then investing in the market at 6%. When this business is generating a 20% ROE, let's keep it in the business. Let's invest in, capital projects or acquisition opportunities. That's just a better use of that money. And, and from a risk standpoint, we know this business. We've got great managers. We know this industry. We've got good visibility that we're going to continue growing profitably. That's just better than investing in, a large cap stock portfolio, which
and I just love
is
the
already
comment.
being done by some other group within our diversified family office. So
it's awesome.
We don't need more 6% return. We need a little bit of that, a little bit of this, a little bit of that, all diversified. And
it's just so helpful, Paul. It's so helpful, Paul, because even if you got a good business with a good strategic plan and good management, and you've got, foresight into where you want to put that money, it's available with common logic, in common sense, which I think is just fast. It's something that's important to know, because that's not the case with a lot of other potential buyers. They're either taking it out to suck out the cash, and then so you're skimping along to try and grow. So it's always about trying to align the forward-looking projection, strategic plan, and desires within your investment thesis. And it's just like you said, it's just nice to how clearly you've laid it out and where you guys stand. And again, it's so helpful then to be able to compare that to other groups where I don't care how they're structured, people need to be asking these questions.
Yeah, they're great thoughts. You're a terrific advocate for sure. I guess one other comment I was thinking when you were talking about fees or sucking out cash, I'm sure there's others, but don't charge a management fee. That's a pretty typical, structure as well for showing up to board meetings and providing, great strategic advice. We don't have any of that, overhead necessarily to cover as well, for the business. So hopefully we're prudently capitalized for the business. We're supporting their growth, and we're not, overcharging it necessarily for, the gift.
For the question of, I had this one guy, he was telling me the story. He's like, my strategic advice and again, I'm not knocking PE firms just in general, but just these are just anecdotal stories. But the strategic advice was every morning, my strategic advice was, Paul, what is the trailing 12 months of EBITDA, please? That's the only thing that matters. So I think it's just helpful, again, just to hear the comparison. When you have conversations, whether it's advisors, investment bankers, sellers, what are some of the big misnomers that you have or questions that you have to constantly explain? Like what are some of the biggest, whether it's misnomers or mysteries or, things you have to debunk, or is there anything that's kind of sticks out?
About our group or our type of group?
Yeah, just about what you're doing. If someone's sitting there, is it common for people to know it, or is there certain things that you have to, typically explain quite a bit?
I guess I have to explain, why spend the money on direct investing when you could just go invest in KKR stock? That's kind of one thing. And I sort of explain that we do that anyway. This is yet.
That's what happens when you have enough money.
Yeah, right. It's a good problem to have. The other question is kind of like generally, how do you make money? They mean how do you realize your investment? So again, it's the explanation around the long-term, ownership, the capital appreciation, the diversification, which is important to us as some sort of, or maybe more important, I guess, as some sort of fantastic, exit opportunity necessarily of the business. I get asked a lot about, either co-investments or outside capital. And it's traditionally, it's a single source of capital. So we write one check that can actually be pretty powerful to people or, certain audience members, depending on the type of group I might be competing against. And we're not looking for no competition. We think, any business owner considering a sale should get great advice from a group like Arcana or other, business advisor exploring their options, and then make the decision that given, if all things are equal in terms of, say, price or other, structural elements, really what do I want out of the transaction? And, we think oftentimes, again, for the right audience, our message stands out. So, that we write one check, we're not taking outside capital, from other sources. The one sort of partner in a deal might be some of the management team, particularly those younger shareholders who are still running the business and, have the capacity to roll over some equity and are interested in that sort of thing. That could be a partner, potentially. And that's a position that's evolved for us over the years. I think 25 years ago when Encore One was first set up, it was very unique and novel. And this marketplace we're chasing 4 to 10 million in EBITDA. It was just completely underserved, under-advised, underbanked. So what we were doing then is a little more unique than what it is today. It's an attractive place to be, and it breeds competition, which is affirmative. We get that. We still think our message stands out. So I think those are some of the common ones. Outside. Do you have outside capital? How do you make money, quote unquote? And
we just want to hold long-term privately held companies.
But I give a couple of examples relating to kind of the economics around holding a business long-term compared to other options, and why it works if you've got this unique source of capital that we have that's designed to really last in perpetuity. So
that's awesome, Paul. Man, this has been a lot of fun. I've got 2 final questions for you. One is, where can everybody find you? I don't know if there's a specific place how to reach out.
Proudly, we now have a website. So welcome to 2002, which is Encore One, ENCOREONE.com. And so quite a bit of our information is there, our history, background, kind of the investment experience we have and what we're looking for, contact information, et cetera, is there. I'm certainly available on LinkedIn. My last name is Moffatt, Moffatt. And we're continuing to work on other marketing initiatives in addition to the hand-to-hand combat of business development. We try to get our names out there, maybe not as well as you're able to, but we're trying. So we've got some other marketing materials, overview, PowerPoint presentations forthcoming. I hope to share that with other trusted referral sources to explain what we do and what's in it for the resource, the referral source, as well as why we can be really great for clients potentially. So
that's
certainly
awesome.
Appreciate this exposure.
You bet, man. And my final question is, I love to ask people what the word intentional means, name of the show. I also get a lot of personal gratification of hearing all the different variations of people's definitions. So in your words, what does the word intentional mean for you?
I wish you would have given me a heads up on this one. Intentional, I guess, to use other synonyms, sort of purposeful, thoughtful, strategic, kind of beginning and a middle and an end in mind, sort of a vision of what the future could be, sort of an aspirational vision of what the future could be.
Dude, I'll tell you what, on the spot, that's not too shabby, man. I liked it a lot. That was very well done. Paul,
That's generous. Thank you.
Yeah, no, man. I thank you so much for coming back on, spending the time with us, and shedding some more light on what you do and how it works.
Ryan, I enjoyed it. Thanks a lot.
Well, I hope you enjoyed that interview with Paul. First of all, I wish I had that kind of wealth where I have to figure out what to do with it, where I'm going to buy companies and hold them forever, because it just makes sense, because other chunks of my portfolio are giving me the 6% return or the dividends that I want. All joking aside, I think it's great that there are investment firms out there like Paul's that are doing the right things for the right reason. And it's about aligning what you want as the eventual seller of your largest asset. And if it's not an internal transfer or an ESOP or other private equity firms, there are family offices out there who are doing direct investments that I think it's possible, if you are intentional enough to align your goals and what you want with someone, like whether it's Paul's firm or whether it's any kind of family office or different flavors of private equity or even a traditional one. It all depends on what you want. There are no right or wrong answers, but the more options and the more explanation we give on these various options, the better educated you are to drive towards the options that make sense for you. So again, if you have not checked out the Intentional Growth Bootcamp, where we dive way into this for essentially almost an entire day, all the exit options, it's at Bethel University on the 2nd and 3rd of November. Go check it out at Arcona.io, where we got the curriculum, we got the trailer, got a lot of stuff to hopefully give you enough information to make a decision of whether it's right for you. So again, thanks everybody for tuning in, and stay tuned for next week, where we're going to be diving into M&A advisory fees and how they work, and how all the different flavors of the intermediaries, business brokers and investment bankers, how they work and what you should expect if selling to a third party is right for you. Thanks everybody for tuning in, and I'll see you next week.